Everyone, and welcome to today's virtual webinar. My name is Margaret, and I am the web host for today. We have a few housekeeping announcements, and then I will introduce our speakers. As a reminder, in order to earn CPE credit for today's session, please stay connected to the webcast for the entire program and participate by responding to at least 3 of the 4 questions. As a reminder, your answer to the question will not affect your credit. There's also a course evaluation we would appreciate you filling out at the end of the program. With that, I will introduce our speakers. Kevin Jacobs is a managing director with Alvarez & Marsal Tax in Washington, D.C., where he serves as the National Tax Office Practice Leader and the co-leader of U.S. Restructuring Tax Services. With over 20 years of experience in both public and private sectors, Kevin specializes in U.S. and international tax matters. Joe Boddicker is counsel in the Federal and International Tax Group. He focuses his practice on federal, international tax, and legislative and public policy matters. Finally, Nate Jones is a lead product manager with Wolters Kluwer. Today, he will be showing us how to find additional answers and resources within CCH Answer Connect. Thank you. Take it away.
Great, thanks. And thank you all for joining us. We're very eager to explore the volatile tax landscape, where it's now become the norm as opposed to the exception. Anything that you're thinking that we may talk about as of a week ago is thrown out the window because of the ever-changing landscape. And as we close out what may be viewed as a remarkable year, we have a first full year under a new administration with unified government control, and we'll reflect on the key developments that have occurred over the year. We'll then turn to the aftermath of the shutdown and what to look ahead, and turning to the election. Obviously, there's already been some posturing that's been done, and thrilled to have Joe back to shed some light on what we should do with the current situation. Deregulation is always a big question, especially because of the administration's focus on it, and then we'll turn to the global tax crosswinds. But with that said, Treasury and the IRS has been very active in issuing guidance in response to the major legislative changes under the One Big Beautiful Bill Act, or OBBBA, while considering a host of open questions that were raised under TCJA. And so as a result of that, some of the guidance is retroactive to 2025, and some is even earlier than that. Now, despite the government shutdown, initial guidance is still expected to occur year-end, and we've already seen some that's been released, and there's been suggestions that there might be even more coming, or even Q1 of next year. Now, most of the guidance previews proposed regulations as opposed to actually issuing those regulations, and they have broad substantive matters remain unresolved. And so it's a matter of trying to understand where we are and where we're going. Now, on this slide, we tried to highlight some of the selected guidance that came out. You can see in the individual side, the big one is qualified tips. That's been something that's been really interesting, and obviously something that President Trump campaigned on. We've gotten clarification on what constitutes eligible tips and rules for determining the 2025 deductions. Now, interestingly, the government gave penalty relief for businesses reporting tip income, and so now this leaves companies wondering, what should we be doing? They're really sort of two paths. You can have a company that decides, oh, we're going to provide the information up front with concerns as to how we calculate it, and is that opening themselves up? Or alternatively, they choose not to provide it, knowing that when the individuals go to file their tax returns, chances are there's going to be quite a few inquiries on the back end. And so as a result of that, companies are now starting to think through, should we provide this up front, or should we prepare for back end inquiries? When you look at the business highlights, we have the big 3 TCJA provisions, which is business interest expense. We have the first bonus depreciation first year 168K, or the 174 R&E expenses, and the ability to now deduct U.S. domestic R&E expenses. Now, this was made permanent, and we've had some guidance, but it's actually been quite limited in this respect. So it's only been in the domestic R&E expenses. There's some guidance with respect to the elections for retroactively expensing and the interactions with the R&E credit. Now, that is a trap for the unwary, because it's not just a quick fix. You should actually analyze whether or not you do or don't want to retroactively expense, for particularly for the small businesses that can go back and file amended returns, because it's not just a simple, oh, I get to do this and I'm done. You have to actually calculate several other implications, including closing the 280cc loophole that we've talked about on past webinars. And they gave some rules regarding the change in method of accounting. Now that's great, but there is guidance that they're still waiting for. One of the pieces that many are clamoring for, particularly in the real property businesses, those that made the electing real property trader business exception to 163J. Now, those companies are exempt from 163J, but the price of doing that is now saying that they're ineligible for the 168K bonus depreciation. Now that the bonus depreciation is permanent, companies are looking to undo that permanent election, and there hasn't been much leeway given by the administration in order to do that. Another area that has been highlighted, and we'll touch on this in a bit, is CAMT and trying to see where the government is going to go with respect to CAMT guidance. On the international side, there's been a host of guidance, and you can see that there's been the change of the CFC taxable year. This eliminated the 1-month deferral election. There's been guidance on how to allocate the foreign tax credits between the short year and 2026. In essence, planning is going to be critical, and it's important for companies to analyze the ramifications of this as this is changing models. The pro rata share changes also expand Subpart F and net CFC tested income inclusion. So companies that previously thought, oh, I didn't have to worry about this because I'm not a shareholder at the end of the year, are now having to pick up their pro rata share. This impacts a host of calculations and analysis. There was a dividend transition rule that was issued, but there's still further questions that need to be figured out, and companies need to really analyze what is the ramifications of this, because all of the old models are by the wayside. The Section 250 deduction had changes as well. This is where there was scope of which income is excluded and how to take into account the sale or exchange of intangible property. With all of that said, I know that's a mindful. I see, Joe, there's the opportunity zones that obviously the real estate community is big on, but there's also the energy tax incentives. And so what are you seeing on the energy side?
Thanks, Kevin. Yeah, there's a lot of uncertainty on the energy side, as everyone knows, given the major changes that were enacted as part of the OB3 process, with some of the most impactful ones being these new FIOC rules, right? And everyone trying to decide how they're going to contend with more complicated sourcing requirements. I think at this point in time, our understanding is by year end, most likely we'll see some additional sub-regulatory guidance on energy tax incentives. We're unlikely to see more fulsome proposals until early next year, but I know this is definitely high up on Treasury's list, and I think they're feeling the pressure and understanding taxpayers' position of not really knowing what to do at this point, wanting to comply in good faith, but wanting to make sure whatever is that they're doing that potentially can't be undone isn't going to set them down the wrong path. So more to happen there, but most often, the most often question we get is when are we going to get some more energy tax guidance, for better or worse?
Well, and what are they going to say, right? As there's been a lot of questions in that area. We've seen sort of clawbacks with respect to critical minerals, and now they're trying to make deals to expand the scope of critical minerals. We've seen a push for Republican governors saying that we want to encourage energy tax while also recognizing in the media that green energy has been what effectively is viewed as on the hit list for the administration. So it's going to be interesting to see what direction they go as the winds blow.
Yeah, I was going to say that's a very good point too, because I think one point that's often lost is even on some of these technologies that were deemed potentially safer, right, like 45Z, are some of the other regulatory wins going to push guidance on, say, life cycle assessment in the wrong direction, right? And how does that impact things that were even potentially deemed safe? So I think that's a very apt observation.
Yeah, and on top of it, there's a host of other things that still need guidance, right? And as part of OBBBA, I know, Joe, from my experience, 1202, the qualified small business stock, is really big, especially because of the expansion. 1202 has been an area that people have been clamoring for guidance for years. I tried getting some guidance out when I was in the government unsuccessfully. There's more questions than answers, and now that they've expanded the scope of 1202, the demand for it has only increased. So hopefully we'll get guidance answering even the most generic, let alone the really particular questions, but it's a great planning opportunity. Obviously, R&E expensing continues to be a question, as well as the new 168N, right? The new depreciation allowance for domestic manufacturing facilities. So there's a lot here. There's a lot on the government plate, and we really need to see, hopefully, guidance soon, and we'll see where they go.
Kevin, can I interrupt you for 1 second?
Yeah.
Was expanded 1202 on your 2025 bingo card? Were you thinking that's the direction Congress was headed in?
So I'll be honest with you. I had several conversations with people in Congress, and there was 1202 was actually on my bingo card twice. One was sort of an expansion, and one was also a narrowing. Okay. So they did expand it.
So it was going to be big, but you just didn't know directionally where we were headed.
Well, I did think that they were going to address some things like the husband-wife and other limitations, which they didn't do. So I heard that it was going to be an expanded opportunity. Let's just put it that way for 1202. But is there anything that wasn't on your bingo card, Joe, that came to?
I thought, based on the grumbling I had heard internally, I thought things were headed potentially in a less favorable direction. But at the end of the day, given sort of the broader policy goals Republicans were pursuing, it seemed natural then to try to expand, but maybe refine in certain ways the policy as opposed to rein it in.
So as highlighted, there has been some non-OBBBA guidance also, right? And so CAMT has been something that we've talked about in the past. That's the corporate alternative minimum tax. It's the 15% minimum tax based off of book profits. There were, proposed regulations, and then there's notices, and really the guidance has been a major walk back, right? And it's really been streamlined and simplified. They raised the safe harbor thresholds. They've aligned domestic M&A rules with subchapter C, and they eliminated the dreaded cliff effect, where if you had $1 of boot, it triggered the full amount. And so really it's a matter of saying they've loosened the rules. Now, one area here, and I know I'm jumping ahead, but it will be interesting to, Joe, if you have also further thoughts. There's been a lot of debate on the interaction of CAMT and OBBBA in particular, for example, the 174 deduction. And so I've now called it that CAMT is the silent killer of all the OBBBA, benefits. And we're seeing that, and more people are pushing it. We've seen comment letters being submitted by trade organizations, and now the Democrats are trying to stick the line in the sand, saying you really shouldn't be excluding everything that you're already excluding, and you shouldn't provide guidance or change the rules to further limit the application of CAMT. Based off of what you're seeing, I think once the Democrats say, I don't want you to be doing this, this suggests I know where the Republicans are going, but where are you thinking? Are you hearing any rumors about this?
Yeah, I think there is a desire to ensure that, and we'll get into a lot of this later on in the presentation, but I do think there is a desire to ensure certain incentives are functioning as intended. What I will say is this, though, is Republicans' ability to perhaps make slightly more surgical tweaks or maybe come in with a sledgehammer for all we know, right, is going to be dictated by the legislative vehicles they have available. And if we're in a scenario where there is a second reconciliation bill, right, one that's undertaken next year, then maybe some of these become a more realistic possibility. I think to the extent that, we've sort of seen the extent of the full-throated partisan policies that are probably possible in today's world, and now we're going to be trending in a more bipartisan direction. So I think a lot of this will come down to, okay, what is the real opportunity that's going to be available next year, and is it going to be available on a bipartisan or a partisan basis?
Yeah, and just to say, I think one of the difficulties that we have, at least on CAMT now, is there's so much optionality as to how you apply the rules, and it's always great from a taxpayer's perspective when you have optionality, except for when you then say, what is the cost of that optionality? And so right now, the way I've just described it is, okay, we now have a spigot, and on the spigot we have multiple pipes that we have, and so you're going to continue the path that's going to be, okay, what are all the different paths I can get to not being subject to CAMT? And then you say, okay, well, I have to maintain books that are consistent with all of those paths to determine when the next year comes about, which one of those paths is still viable versus not. And you don't have to necessarily disclose to the IRS which path you're pursuing, which causes multiple sets of books, right? And so we've already talked about how CAMT imposes sets of books. This is just books upon books upon books in order to determine whether or not you aren't subject to the CAMT. And determining what is most beneficial. We also did have guidance on the excise tax, which was rather favorable. They excluded, most of the corporate reorganizations. We have leveraged buyouts and take private deals were excluded, and the dreaded funding rule was eliminated. So you can see how a lot of the dreaded stuff, like the cliff effect on CAMT, and we had the funding rule and the excise tax, it's really a softening of the views that this administration is taking to previously issued guidance. Looking on the non-OBBBA guidance, we've had a few different things, including international rules. The key one just to think about, and this goes back to the softening of guidance, is the partnership transactions, saying that they intend to withdraw the partnership basis shifting transactions of interest. Now, without jumping ahead, the transactions of interest and whether or not something is or isn't appropriately identified as such, is a totally separate area that I know we can get to when we talk about Loper Bright. But the fact that they're withdrawing something that they viewed as abusive, I think, is another sign of what is the administration looking at. And it's sort of in line with what everyone has been saying. We thought that if the Republicans were in control and President Trump was elected, that we would see a walk back a lot of the what might be viewed as anti-corporate or anti-taxpayer views. I don't know, Joe, if you have initial reactions to that statement.
Yeah, I think the rollback was expected. I think, quite honestly, the question that we often get too, what is the service's capacity to carry out any sort of enforcement priorities at this point in time, given the constraints on its resources? I think some of this is interesting because, right, in the absence of a commissioner, right, when we have an acting commissioner, in the absence of a chief counsel, when we have a lot of people slotting into sort of acting roles, is that, are a few people able to sort of push guidance in a direction that is helpful, or ultimately is some of this rollback going to be less surgical because we don't have the bandwidth to actually take on some of these things?
So you can see we've launched the polling question, which is going to lead to our next topic, which is which party is more to blame for the government shutdown? Is it the Democrats, and seeing apologies that there's a typo, Republicans, or both parties equally? We'll see how the the audience feels, but let's talk about the shutdown, right? And there's a lot of things to be mindful of. Obviously, this was much bigger than just the IRS, but it impacted the IRS immensely. And what happened? Well, as a result of the shutdown, right, you have to identify who is essential and who isn't. And if you're not essential, then all the work that you were previously doing came to a stop. There was no one that was really picking up the slack for that work. And so now that the shutdown is over, they have to address the backlogs of all the filings and dealing with where do we go from here, right? It's going to, in essence, be patience is a virtue, and we really need to be patient because there's a lot of things that were happening behind the scenes, and there's an ongoing backup. For better or worse, regardless of how you view the IRS, they are generally understaffed. The ask that we have is part of an agency that is pretty much the sole source of revenue, is one of the things that they're tasked with an immense duty, and the technology that they have, while they've been forced to sort of upgrade it as part of the pandemic and so forth, has not caught up to speed. And so as a result of that, it's been really trying, especially when you then have, we need to deal with OBBBA and figure out how do we modify the forms? How do we file instructions as filing season is right around the corner? On top of that, you could see on the slide, we have use or lose. What happens from a calendar perspective is employees of the government have to use their vacation, otherwise they lose it. It's not a roll forward. And most of the time, you see December and the beginning part of January being the use or lose season where a lot of people come off. Now, they had a lot of time that was off because of the shutdown that didn't impact their vacation accruals. And so now you're going to start seeing people getting up to speed only to then take the time off for their use or lose. And Joe, I don't even want to mention this because I'm concerned about jinxing it, but this last bullet about another government shutdown in January, do I just pretend it's not on the slide and move on, or do I even want to ask you about it?
I mean, I don't think it's a realistic possibility, but is it a possibility? Yes. I too don't want to think about it. I think a 43-day shutdown was plenty disastrous for the country, right? And it's sad to me always that most Americans, this is very different for tax practitioners, right, who are interacting with the IRS and with Treasury on a somewhat regular basis. It's a completely different scenario when the real thing that moves the needle politically is flight delays, right, and people's safety being thrown into threat or thrown into peril. And then ultimately, it's things like that that make people realize that having and operating an open federal government is an important thing. So no, I too don't even want to think about that. But I will say this, it is clear from the length of the last shutdown that the sides don't trust each other, right? And they don't trust that whatever is being agreed upon is actually going to be honored and carried out. And as a result, it makes a shutdown likely. That said, given that the outcome of the last shutdown was very little for Democrats, I don't know that there is the same incentive to shut down again. I think the point has been made. Now, whether or not that is a strong enough point to the Democratic base remains to be seen, but I don't think there's much to be gained from another shutdown. I think what is the big battle, and this segues nicely into the next slide, is, right, who prevails in November 2026? How is control of government then affected? That's the game folks have to be worrying about, because there's little else that can be done in the near term to upend Republicans' advantage, or at least the way what they perceive their advantage to be. Whether or not that is objectively an advantage that's held currently, little will be done to disabuse them of that notion, because as we all know, for most purposes, there's a 60-vote threshold of the Senate that you have to achieve that requires bipartisanship on some level.
which we did get a comment. I mentioned that we have a unified government, and as noted on this slide, right, they're not at the 60 vote thresholds, and so it'll be interesting, as you're going through your analysis, do you think that they're going to get there? So with that, Joe, what do we have on the current view, the redistricting, and so forth?
Yeah, so I think there are two general approaches in politics to winning the race, right? Either you change the rules in your favor, or you change the starting or stopping line. And it seems like what's in vogue, at least in this year, is the changing of the starting or stopping line. And there's Republicans have launched themselves headfirst into a redistricting battle. Ultimately, most commentators view the redistricting efforts as trending in favor of Republicans. That said, I don't know that the net effect ultimately is going to be as impactful as originally thought. And if anything, we're seeing a scenario where this is really losing the trust and support of independents, and I think that will have ramifications for many years to come. So there's sort of you even if you win the battle, you may lose the war, right? Because you're really eroding any sort of trust that exists. Obviously, we've all been watching what's happened in Texas with the new map there and the Supreme Court ruling in favor of it. Most observers thought, okay, there's a difference or a distinction to be made between sort of this congressional map for the upcoming election and then for future maps, right? Maybe intellectually there's a different analysis that needs to take place. Others will say you're splitting hairs, right? You're just trying to come up with an interpretation that serves your current purposes. But and on the other end, we saw, California, right? And California approved Proposition 50, which suspended the state's independent redistricting commission and is going to potentially claw back 5 GOP seats. So if anything, Democrats have proven that, hey, Republicans, we can play this game too. And so you need to take it seriously. And at the end of the day, this is likely going to be much closer than anyone thought initially. And I think it'll probably not determine the outcome, or at least not determine the outcome of the House or control of the House. But we will see some movements around the edges. I think, Republicans in this approach, at least my impression is, and this is in keeping sort of with the administration's approach more generally, which is sort of the move faster, right? To sort of move fast and break things and figure out what you want to do thereafter, whereas Democrats continue to rely on the courts, amendments, voter referenda, right? So you can see just procedurally what is appealing to the two parties too right now, right? And sort of what is deemed to be the best approach. But what is clear though is everyone is exhausted. So it's not just you at home watching this all play out from afar, but even those participating, arguably maybe those participating in Congress are even more exhausted, right? Because we see a huge number of retirements. I'm sure everyone saw the headlines, announcing the retirement of Marjorie Taylor Greene. Clearly, she had some recent troubles with the president, but I don't know that anyone expected her ultimately to just throw her hands up and say, I'm done with Congress. I mean, as recent as within the past couple of days, Republican Nancy Mace of South Carolina, right, wrote a piece for the New York Times saying, like, at the end of the day, the process is broken. Leadership is forcing our hands. They don't care about our input. And as far as leadership goes, Nancy Pelosi was a better leader than Mike Johnson, right? Which is just sort of this friendly fire that I think ultimately, from Republicans' perspective, isn't helpful to them maintaining control of the House. But there is tension, and I think what is perhaps different now, as I sort of sit back and reflect on what's happening in the House and to a somewhat lesser extent in the Senate, in that, as we discussed earlier, right, there is that 60 vote threshold for a lot of legislation forcing the Senate to be a little more nuanced. In the House, it's always been a top-down leadership style. I think what is different this time is rather than that top-down leadership coming solely from the speaker and the majority leader, that's coming from the president. So I think in many respects, the leadership in the House Republican leadership, is having to react to the president in a way that is not being well received by the rank and file. And I think no matter what, nobody likes to feel like what they're doing has no purpose. And I think we've gotten to a place where everyone is just waiting for the man in the White House to tell them what to do. And so it should really be no surprise that in that environment, a lot of Republicans are saying, hey, there are better things to do with my time. This isn't really fun anymore, right? I think a functioning Congress, well, as I'm fond of saying, I spent 8 years working in the Senate, as I always tell folks, when you're legislating, when you're working on things, and especially when you're working on things on a bipartisan basis, Congress is a very cool place to work. You get to do very interesting work. You get to work with very interesting people. Where that experience starts to suffer is when those things don't happen. And we're seeing firsthand the effects of not being able to legislate, what that means for people's job satisfaction. In a world where members aren't making that much money, this is perhaps not the thing they want to be spending their time on. So I think if we go to the next slide, you can see sort of the global picture breaks. Yeah,
they're not making much money, Joe, right? But we do have the golden parachute, which is why Green sticked around through January.
Yeah, exactly. Yeah. There are certain incentives for certain timelines. That is correct. But for sure, it's not worth it. You'll see here what's motivating a lot of Democrats is running for essentially higher office, right? I don't know if or gubernatorial office. I don't know that I can draw the same sort of conclusions with respect to what's motivating Democrats, other than to say, a lot of them probably are looking to either trade up or get out, right? Which is different from what's motivating Republicans. If you go to the next side, they're either going home or, for the most part, going home, or they're running for state office where I think they feel like they can get more stuff done. And in today's world, I think that's true. It's probably a little more interesting to be the chief executive of your state than to be a rank and file member. I think that's different from being in House leadership, for sure. The Senate retirements are less, I would say, interesting, other than, well, what I will say is this: there's sort of these stated Republican retirements, and then there's sort of the potential election-related retirements, right? And I think the thing to keep in mind, going back to that very first slide we put up, the threshold in the Senate is 53. And we talk about, okay, what are potentially vehicles right now for people to latch tax priorities on? Well, what can we have 53 Republicans in the Senate support, right? There's not a lot. If you look at that list, you see potentially where Tom Tillis, right, Mitch McConnell, maybe even a Joni Ernst, because of their retirements, not necessarily being willing to play along in the same way, to the extent we see a major departure from what has long been sort of standing policy. Similarly, when you have a Lisa Murkowski, right, or a Susan Collins, who's going to be in a very tough reelect, I think realistically, you need 60 to end debate in the Senate. You need a simple majority to pass a bill. But Republicans are probably, in most instances, going to be starting with 49 votes or 48 votes, right? Once you factor in those members that are going to be taking more nuanced views. And so if you approach your analysis from that perspective, ultimately their ability to move legislation and what most of us care about on this call tax legislation, right, is going to be very limited on a partisan basis, if not impossible. So then the question becomes, okay, what potentially is available on a bipartisan basis? And I think that is going to greatly inform what is considered. Inevitably, what happens in January with funding the government is going to be bipartisan, and so that's going to create an environment. But if we go to the next slide, we have a polling question, so I want to make sure I don't get too much into the likelihood of tax legislation before we pose the question to everyone, which is, which party will control Congress after the 2026 elections? Are you expecting unified Democratic control? Are we going to have divided control, which seems to be the common practice once we've had a wild swing? We as a country moderate ourselves more. So, that would give you, with Democrats controlling the House and Republicans controlling the Senate in B, Democrats controlling the Senate, Republicans controlling the House C, or Republicans will continue their trifecta and run the table, reclaim all their glory of the past election.
So Joe, while they're answering, why don't we think about what other insights can we have on tax legislation?
Yeah. So obviously, an election year is a terrible time to have to pass any sort of tax legislation, right? Especially when it's going to be a hotly contested election. Generally, bills are not going to be taken up prior to the election. What makes this year different, right, is we do have this big funding deadline, January 30th. There's going to be a revenue vehicle. Now, the question becomes, ultimately, will that funding measure, the one that's going to be necessary to keep the government open, can that bear additional policies, right? Obviously, leadership on both sides of the aisle is reluctant. They're reluctant to allow a big Christmas tree bill to advance. So that's always a major consideration. But we are potentially going to have two windows where, for sure, we expect some revenue measures to occur. Now, that will be that first window, like I said, January, February. And then the second window is going to be the lame duck session, right? Once we already know the outcome of the election, there aren't the same electoral headwinds or tailwinds to factor into your calculus politically as you're working on some of these things. And so there will be another window there. Obviously, should something come together in January, that would have to be on a bipartisan basis, right? I don't think right around that deadline there's any chance of us seeing any sort of partisan activity, right? We're talking about taking a government funding measure and tacking on tax extenders, potentially the ones that weren't addressed in OB3, maybe extension of WOTC or some of the other low-hanging fruit out there, or another thing that's thrown around is addressing some of the gambling loss changes that were made in OB3, right? Those things seemingly have strong bipartisan appeal and wouldn't poison the process happening around government funding.
Now, right? We'll have to see what happens overseas, right? And we'll get to the 899 as that might be one of the
exactly. And that's a great point, because that's what I was going to say. What could potentially unlock a partisan vehicle? I mean, as we all know, Republicans do, in theory, have the ability to move another big reconciliation bill. And I think some of that is caught up in geopolitics. So with that, I will turn it over to you for a discussion of deregulation.
Yeah, so this is actually sort of fascinating, and there's been a pendulum switch, which is we had Loper Bright. It's a Supreme Court case that overturned the Chevron doctrine, and now courts can now apply their own judgment on what's viewed as ambiguous statutes in determining what is the best interpretation. Now, this is something that's been widely sought after, but also widely feared, because what that means is each individual judiciary can now come up with their own interpretation. And so form shopping becomes live, but we haven't seen a plethora of Loper Bright decisions as of yet. But there have been some. There's greater scrutiny on tax regs, right? And now taxpayers' positions are gaining greater weight. Now it's sort of interesting because notwithstanding Loper Bright, like the standard for what is a tax reporting position as to whether or not it's reasonable basis, substantial authority, and the like, that hasn't necessarily changed the analysis, unless of course you try to argue that those standards should be subject to Loper Bright. But we've now seen even further development in Treasury preambles to show like APA compliance and statutory authority. And so now it really leaves open the question of how are courts going to apply Loper Bright to tax cases? Is there such thing as a interpretive regulation in the tax rules, or because of the broad grant of authority in the Internal Revenue Code, everything is viewed as legislative? And historically, the IRS has said no, it's interpretive, and so as a result of that, you now need to figure out the distinguishment between interpretive and legislative. We did see the Varian case in which the tax court invalidated the TCJA regs denying the 245 Cap A deduction. And then we, most recently, right, just a few months ago in the 3M case, the 8th Circuit invalidated the 482 blocked income regs. It's important to sort of just think through and say, where do we go from here and what is the broad implications? When I was working at the IRS and TCJA passed, Treasury had asked the Congress for as much reg authority as they could, and they didn't get it, right? And that's some of the reasons why some of the decisions were made in implementing TCJA. Here with OBBBA, we actually did see in many places a broader grant of explicit authority, and it was tied in part to some of the concerns or questions associated with Loper Bright. But I guess, Joe, from your perspective, what do you see the Loper Bright implications, not only from a congressional, how do they apply legislation, but also, from a regulatory implications?
Yeah. For me, I think the biggest outcome of Loper Bright is probably Congress taking note of the fact that it needs to be a little bit clearer in areas where it wants to grant specific reg authority to write the rules in the way where, Congress often punts, right? But it doesn't like to acknowledge it's punting, and maybe being a little more deliberate in announcing, hi, we're definitely punting here. I think that's the big takeaway. If anything, I think most lawmakers are on notice now that it's not good to hide behind just sort of the general rulemaking authority that Treasury has, and they need to be a little more explicit in how they're providing that. So I think that's the big takeaway. And then I think there's this focus on the best reading of the statute, right? And on one hand, it is probably heartening to some to think, okay, fine, the same sort of games can't be played, but I think it also is maybe serving as notice to others that, okay, when we're working on tax laws, when we're proposing changes to words, that we need to be really thoughtful in that. And it can't be just a matter of we push, Congress can get it through, they can get the president to sign the law, and then we figure out what we're doing after the fact, right? I think there's a little more work now needs to be done on the front end, and I think people are coming to terms with it, at least in my meetings at Treasury. Normally a nice icebreaker for the meeting is, how is what you're proposing possible under Loper Bright? Let's let us know, right? And so I think just getting people to think through that in a way that we're doing today is honestly quite helpful and probably good for the system overall. But I think there's going to be some learning, some pain as Congress learns that, okay, what it thought it could get away with previously is no longer possible. And so they're going to really have to take into account grants of statutory or regulatory authority.
Yeah, and I mean, on top of that, we've seen, the executive orders. The administration has been pushing for, deregulation in that regard. You're supposed to eliminate 10 regulations for each new one that they push. Now, we haven't really fully seen the 10 for one. But also, as noted at the outset of this webcast, we also haven't seen a lot of regulations. We've seen intent to issue regulations. And so how that factors into the 10 for 1 is an interesting workaround of sort. If you say, well, I didn't issue the regulations, I'm just intending to issue the regulations. But taxpayers can rely on this while we're still working on finalizing the regulations is sort of a potential interesting sidestepping of the 10 for 1. Now, obviously, the deregulatory initiative has been an open call. And so, we welcome any insights that the attendees have. Feel free to put it in the chat, which packages or regulations you think should be rescinded. But it's really interesting to think about. It's sort of open season for regulations now. And the government is sort of welcoming, or at least the administration is welcoming it, which is going to lead to greater levels of uncertainty. Who knows which regulations are going to be proposed to be withdrawn. And it could be regulations that people are planning or using certain structures in order to implement their transactions, which may or may not be necessary. We saw that in the excise tax regs, where people were using certain structures that are now just not necessary because of how the approach they took in the final regulations. And so it's going to be really important to proactively monitor any of the challenges to regulations, as also any developments. Are we hearing the scuttlebutt that they're examining these regulations? Being mindful of the time, we'll launch the next polling question, which is, do you think there will be a tax reconciliation bill in 2026? And this will tie to the next topic that we're talking about, and we hinted at this, which is the global crosswinds, which is, one of the key questions that we've always had is, where do we go with respect to Pillar 2? And as everyone knows, Pillar 2 is the OECD or global version of a book minimum tax. Countries are trying to implement this global minimum tax, and the U.S. has always been, or the Republican administration has been upset, and Republican members of Congress have been upset about how the negotiations took place. And so as a result of it, they've been trying to find a way out for U.S. companies. And that was where we had the agreement of the G7 or an understanding is technically how it was worded, Joe, right? That that the G7 will try to say, okay, we can look to have a U.S. side-by-side. Now, what does that side-by-side mean, and how does it apply? There was several discussions about what it meant, and it didn't seem to cover all of the originally envisioned structures. But in essence, they're looking to say that most U.S. companies or U.S. parented companies wouldn't be subject to the implications of Pillar 2. That's what they're trying to drive at. Now, there's a lot of uncertainty here, both on how is, Pillar 2 going to be implemented. Just because the OECD says this is what we want you to do, each country needs to, in essence, develop it. And is there a viability for a U.S. side-by-side? There's a lot of countries, including after the fact, G7 countries that have been attributed comments saying, well, we're not sure if the U.S. should get an out for this. It really can impact us. And so there's a lot of chatter that's coming here. And really, if the OECD stalls, and a lot of people are looking for a year-end movement on this front as it relates to a side-by-side, there's talks of this potential 899 coming back. And we talked about 899 before, and it's the retaliatory tax that Congress can pass. Now, obviously, if they're going to pass it, I think, Joe, you would tell me that's going to have to be presumably in a reconciliation bill as opposed to a bipartisan bill, and where they may go. So I guess, Joe, what's your thoughts on what you're hearing? OECD 899, should we be, we threw out all the playbooks on 899 complaining of everything that didn't go wrong. Is it now possibly coming back again?
I think it's highly unlikely that we see 899 come back, though I do think there will be a significant amount of saber rattling if ultimately we don't see some real progress here. I mean, obviously the rumor is that at some point this week, we're going to see some sort of statement on the side-by-side, whether that is a formal agreement or sort of a political agreement. Your guess is as good as mine. I mean, there was also a rumor of certain things circulating behind the scenes with inclusive framework members. So, time will tell how true these rumors are, but I will say 899, when considered in conjunction with a number of other policies, right, is way more dangerous than, say, 899 on its own, because I think under the scenario we're looking at reconciliation, it's very hard to carry what are very slim majorities, narrow majorities in the House and Senate, and vote just on 899, just because there was some walking back of the gentleman's agreement, right? It's very hard to make the case that we need to, if you listen to critics, blow up the economy just to make the point you don't go back on the deal. Now, is it possible that 899, should we not see sufficient progress on the side-by-side solution? Should we see other areas of tax policy hanging out there? Could it be cobbled together with some other policies and find its way into a reconciliation bill? For sure, and then I think that situation changes slightly. What I will say is what I'm watching closely, and this is sort of an overarching view of what we have on the next few slides, which should be good for time, but it's what happens on 899 and the Pillar 2 side-by-side, right? What happens on Trump's tariff authority under IEEPA, and is there a push to codify some of the tariffs that potentially have been struck down by the Supreme Court, right? Because codification of those tariffs in law would raise revenue and also presumably would be available to Republicans through reconciliation on a partisan basis. There's this sort of secondary issue, which essentially was the primary issue why we got ourselves into this OECD project in recent time, which is how do we solve the digital services taxes, right? They seemingly aren't going anywhere. Is there a need to address or impose some additional changes related to them? And then, at the end of the day, what happens on the ACA subsidies, right? Is there a bipartisan solution to be found, or do Republicans have to find their own solution? We talked earlier about how, in a partisan second reconciliation bill, it might be very hard for a Collins, a Murkowski, a Tillis, right, to sign on to that. But if you're solving the ACA subsidy issue in a way that they agree with, maybe that makes it easier. Maybe it unlocks a bill. So I think ultimately what happens on these big issues are going to be super impactful, and ultimately they're all somewhat interrelated and will drive whether or not we see a second partisan bill. But, you see on this slide that the U.S. government could owe up to $1 trillion potential refunds. That'll be a big stimulus to the economy, right? Should that happen, but it'll also be very problematic because we're not going to be bringing in revenue that as we originally thought. Now, query whether some of these new announcements, the bailing out of farmers, right, who have been harmed by what were our trade war with China, if some of that was already eroding, the revenue gains that were potentially being made by these tariffs. But I think at the end of the day, all these items are going to have major implications for our fiscal house, and we're going to need to take steps to get it in order. It really depends on whether that will be on a bipartisan basis or a partisan basis, and only time will tell.
Yeah, and it's fascinating, right? Because on the one hand, at the Supreme Court, they're like, oh, this wasn't done to drive revenue, and now it's like, oh, we're going to be sending checks to all of the Americans out of the revenue generated by the tariffs, and now it's like, okay, well, what happens and how can people potentially get refunds? And there's a lot of questions that are out there. But I guess time will tell. Many people thought that we were going to have the decision already, but we don't. And so we'll go from there. But with that said, Joe, thanks again for joining us. You always provide great insights as to what's happening on the Hill. I guess, Nate, what should we know from an Answer Connect perspective? Nate, I'm not hearing you.
Double mute going there, so hopefully you hear me coming through now. Oh. Yep, perfect. All right, so all that you really need to know about CCH Answer Connect, and I only have a few minutes to kind of close things out here, is that we are basically an AI-powered research tool operation now. So we still have all of the exact same content that we've had historically. And now, instead of having to know what library to go into or where you need to go or how to do Boolean search connectors or any of that old school search methodology, now you can just come into our Answer Connect AI view or our AI workspace and just ask a simple question. So one of the ones that came up today was what provisions of the OBBBA are most at risk of being limited by the CAMT. So if you wanted to go through and just ask the research tool here, it can go ahead and do that just as easily as you would ask a colleague, like we're talking here on the phone or on the webinar. And you can see these are the various provisions of the OBBBA that are likely going to be the ones that are most at risk of being limited by the corporate alternative minimum tax. So it makes research really easy. And the other thing that I'll show just briefly here is that not only can you do just this general, what we call theoretical research, but you also can take various fact patterns and put those into the AI and then ask for the AI to assist you in completing some sort of a calculation. So I'm actually going to ask the AI assistant here to work on
Nate, I'm sorry to
tax
interrupt,
provision
but we
for
can't
me.
see your screen if you're sharing your screen.
Can't see my screen? Okay. Let me try that one more time. All right, hopefully it's coming through now. Or no? Try this one more time. Okay.
Now I can see it.
All right, let me just we'll do it this way here. Hopefully this now. Oh.
Yep, I can see your screen.
Yep, all right, great. So I'll just kind of retrace my steps here. So originally I had asked Answer Connect what are the provisions of the OBBA that are most at risk of being limited by the CAMT. So the AI is able to go through, reason through all of the content that we have in our Answer Connect library. It doesn't go out on the internet, anything like that. And it just gives you a bulleted list of, what are the provisions that are most likely to be limited right there. And then what I went on to say is that not only can you do this theoretical type of research, you also can give the AI assistant in Answer Connect a fact pattern that you're working with and ask for its assistance in drafting some sort of a calculation. So I like to use a tax provision example to show this because tax provisions, when you do them, you have to draw from our accounting and audit library because it's an ASC 740 reporting requirement to do a tax provision. You have to look at the federal tax library to understand what the various deductible expenses are going to be, what the credits are going to be, and then you have to look in the state tax libraries as well because you have to pull various state tax rates and state tax credits. So I gave the AI a fact pattern here. Basically, here's your pre-tax book income, here's some Schedule M adjustments, here's some state tax adjustments, here's some apportionment factors, and then I asked it to go through and prepare a tax provision for me. I didn't give it, what the tax, kind of scroll down and take a look at kind of the thought process here. It was able to reason through 142 different steps and then basically generate a tax provision for you on the fly. So you can see kind of all of that coming through here. You get your overall state tax base as we go through. You get your state apportioned income and you get your calculated current state tax expense. We calculate the federal expense as well, the federal benefit of the state, all that to come down to your total tax provision of $521,000, and then ask it to go through and do a rate reconciliation for you as well. That kind of summarizes, exactly where that number came from. And as we continue down through the list here, you can see the AI automatically basically cites all of its sources, so it's going to show you exactly where these rates were pulled from, one of these citations afterwards to see where the rate comes from, and then you also can basically open that document and then view that automatically right there as well. What's also cool is now you can say, hey, do the same fact pattern, but for an S corporation, and see how that goes. So now the AI will take that same fact pattern that we had just given it, and we'll now do that same tax provision, but using S corporation rules instead of C corporation rules. And again, because this is all tied into the research libraries of CCH Answer Connect. It's able to go through and calculate basically a tax provision for a C corporation from a bunch of states on the fly, as well as for an S corporation for a bunch of states on the fly. You can see the AI kind of reasoning through this thought process here. It's going through, searching for what the various rates are in the states that I had asked it to, and then pulling together all of the various pieces of content that walk through how to generate the answer. You can see it reason through 124 total steps. And as we kind of go through, you can watch the AI kind of in real time, building out what the calculation should look like. And we should see as we kind of go through this a little bit, still generating as we go here. So just bear with me while I'm waiting for it to finish thinking through this. But what we should end up seeing is that the tax rates are a little bit different at the state level than they are at the state tax rates are going to be different and an S corporation world because there is no state tax for most pass-throughs in most states, but you'll see that since I left California in there, they do actually have a 1.5% tax that's levied. So it shows you just the power of the AI, where not only can you use it to do research, but you can apply it to fact patterns that you're dealing with and take what would have taken you maybe minutes, hours maybe, and get all of those calculations done and drafted in really short order. And then obviously if you wanted to generate this as a memo or summarize it all as a memo, you can use the AI to do that as well. So basically, Answer Connect now is powered by conversational AI, and all of the content libraries are still there, but the way it's easier to interact with than ever before. So I know we're at time here, so I'll toss it back to you, Margaret, to wrap it up for today.
All right, thank you, Nate. If you would like to learn more about Answer Connect, please let us know using this following polling question. As a reminder that these polling question answers do not affect your CPE credit or your eligibility. And also, a CPE credit will be posted within 7 business days. Today's webinar has also been recorded. We will be sending you a link to access that recording within 24 hours. We thank you all for attending and have a great day.